Hello, Nick Stewart here, and this international real estate investing video, we're going to look at free markets and the importance tax plays in making your investment decisions. And we're going to look at primarily the UK, Ireland, and Spain. And as I said, three quite different ways how tax really impacts on how you're going to invest. So let's get into the video and you can see for yourself. So as most of you will know, tax plays a major part in all of my business activities and especially my investing. It's the number one factor first. As I say, it's not what you pay for an asset, it's how you pay for an asset. A perfect example of this would be the Spanish property market. Primarily, let's look at the Marbella property market. And in essence, you have round trip buying and selling taxes of 25%. So as a real investor and not a lifestyle investor, it's very hard to make money. In essence, you buy a property for $1 million, you've got to sell it at 1.25 just to recover your costs. And that's not really beneficial compared to other markets, what I would call buy-to-let markets. However, if you're a lifestyle buyer and you're going to run it as a holiday, you're going to live in it and rent it out and you're going to enjoy the asset, then Spain is one of the best lifestyle destinations on the planet. So how do investors in Spain make money with 25% in buying and selling? In essence, they become the developer. So they will invest in buy a plot of land, let's say for €1 million as an example, and they will put a project on that to build a completed villa. For example, let's say the building costs are going to cost 2 million, and they'll then put an end price of maybe 5 million on the villa, as an example. And the great thing about Spain and Marbella especially, that we have a system, there's Infocasa resales online. In essence, you have 1,000 international agents working for you. So you take this project and you give it to one of the best agents on the coast. There's only about 5 or 10 that are worth knowing, who will basically commercialize it for you. And they will get those 1,000 agents running around finding a buyer for you. And the buyer will go in, buy the land, build the project, etc., etc. And as a developer, you will come out as a profit. And the great thing is, at the end of the day, you're acting as a developer now. So in your cut, you're still going to pay capital gains tax on the profit, but you'll be able to offset all your costs. It'll be just like running a business. You'll be able to claim your building costs, offset those, etc., etc. And the tax rate as the tax rate as a developer is much better than as an individual property purchaser, etc., etc. The tax rate when buying, and all the taxes that buying and selling taxes, you're able to offset in your books, etc., etc. So it's just much more tax effective, and it's a really good way. The problem now you have in Marbella is everyone else. I started this model back in 2010, and I probably wasn't the first person that did it, but now hundreds of people are doing it, and there's lots of people fighting for the land, etc., etc. But the model still works. You just have to be connected with the right people to invest in that sort of way. Then let's take a look at Ireland. Now, about a year ago, I was actually chatting to a client on another project actually in the Philippines, and he was from Dublin originally and was telling me about the Dublin market. I knew nothing about the Dublin market at that time, and it made a lot of sense. You're basically getting 10% yields in Dublin city centre, not in the prime locations, but in the secondary locations. So I started to look into this, and one of the big drawbacks of Ireland, and is a sort of tax jurisdiction issue, is if you want to buy in a company name rather than your own individual name, you need to basically buy, you have to be an Irish tax resident. And unique is therefore, so the structure of the way that I do my business is I buy everything through my company. The tax element made it very, very difficult. I could have put it in my own name, put it all in my own name and everything else, but then the tax implications, there's like 2 levels of tax. Very interestingly, in Ireland, they have lots of different taxes. So if you're a corporation, you can pay 12.5% tax, but if it's property, you're up towards 20-30% tax. So what I did is I then looked, I went into investigated all this, and also the company and the problem was in my lending or my financing, I wanted to use leverage, finance leverage to buy more assets in Dublin. That was the plan, and again, it wasn't tax effective, because unless you were an Irish tax resident, the lending institutions wouldn't lend to you. So it was one of those. Then I went to have a look at Manchester, and Manchester became in the UK became so much easier. So even though the return or the yield in Manchester was only about 6.5% compared to the 10% of Dublin, when you stripped all the tax elements from the UK compared to Ireland, it actually was offering you a better return. None of the administration problems of being tax resident, etc., etc. The UK is very, very simple. You, as an international investor, you set up an SPV, either an overseas company or a UK private limited company, to buy the property. You can offset all the expenses against that. And the great thing about the UK, there are companies out there that you can buy a company and register the company for £500, and you can get the accounts done for £300 a year. So it makes perfect sense. And actually the returns made much, much more sense in Manchester than it did in Dublin, even though the yields were much higher than Dublin. Now, that was my own situation. Somebody, if you're an Irish tax resident, the situation in Dublin makes much, much more, business sense than the UK does. But you have to know these markets, and you have to take into consideration the tax elements. In a nutshell, those are basically 3 simple ideas or examples of how tax really impacts how you look about doing an investment, and why you should always look at the tax angle as well as the investment return, and make a decision based on both. And as I said, I ended up investing in Manchester because instead of Dublin, because it made more financial sense when I looked at the tax situation and the investment return. Okay, I hope you found the video interesting. As usual, if you did find the video interesting, please like the video, please subscribe to our video channel, and please hit the notification bell so you can get more videos just like this. Look forward to seeing you in the next video.
Thanks for watching the video, and please feel free to connect with me on my personal website, nickstewart.co. Really looking forward to hearing from you. Bye for now.